Hi and welcome everyone again to another episode of Onyx in the World of Oil Derivatives. I'm Greg Newman, the CEO of Onyx Capital Group, and I'm joined with the research team again. We've got Ehsan, Vincent and Audrey and their dulcet tones. So let's just start with the usual. It's more of the same, isn't it? The Brent crude futures contract is not reacting bullishly at all, despite the OPEC decision at the beginning of the month. We are on the way down more and more, and the front spread's even getting close to contango this morning. So Vincent, do you want to start us off?
Yes. So obviously previous 2 weeks, early April, OPEC cut, massive bullish reaction, but then it seems like this the excitement has really faded away. Prices are back to the low 80s, WTI falling down to 75. More the bearish investors are returning, so it feels like the bullish thing was very short term, very fickle. So it begs the question: what was the cut even? What was the cut even for? Did it meet the OPEC's objectives?
It helped the oil traders to get rid of their length, right?
Yeah, that's what we discussed a couple of weeks back, right? It was very clear from the data that actually, if anything, it was a liquidity opportunity, and that's all it served. But what's interesting to us, I guess, is suddenly all this talk, I guess on the back of last year, but that it's financial markets, it's financial market flows that are so important and driving this financial market, and it's the physical that's linked to it. Tail wagging the dog type thing. But actually, like I just put on this LinkedIn this morning, this time it's not actually about financial money at all. If anything, it's the financial market, but it's the speculative flows, the hedge funds, the financial money. They're the ones that are buying. They're the ones that are, doing as OPEC would want. It's the oil traders and the kind of fundamental flow-driven traders who actually don't have the bullish sentiment. I think that's the big news that we keep kind of pushing lately. And now the open interest is very low. Just the sentiment and the belief in the market is kind of gone, right? I mean, that's what we're saying.
Yeah, I think in our CFTC report so it was Monday for the data from last week, we were kind of saying, at least in Brent, the management money positions were really kind of lacking a direction. There was an increase both long and shorts. We kind of noted that there's just no axe for that bullish appetite anymore. And we kind of made a point that obviously because the data is so lagged, so we're going to get the data for up to yesterday, this Friday. It's probably going to show, some of that length stopping out again, some shorts coming back in. Because if you think of like the end of last week, the hedge fund
stopping out.
Yeah, exactly. Because
does it feel like that? Like OPEC has miscalculated this, as in like they expected they didn't expect the oil traders and the majors to just get rid of their length and
betrayal.
If anything, I think they're relying on those ones to be the ones that reacted, and the consensus in IE week was that the general market was bullish. And you're going to say that, right? You're holding a huge long position. You're obviously going to say you're bullish. Yeah. But as soon as the opportunity was there to get out, they did, which shows the lack of confidence. So yeah, I guess they did misjudge it. But yeah, I mean, what's also interesting is we were searching for news, weren't we, yesterday? And there's like, no one's really got a handle on talking the market up or talking the market down at the moment, right? So even the news is kind of boring.
Yeah.
So the open interest has gone out of the news as well. You know what I mean? So, is there anything anyone wants to bring up, like on that macro front? We've got a bit about China.
Stats were kind of interesting. I mean, it was like 6 million barrel draw versus a 1.6 million barrel expectation. That's massive. Prices haven't really reacted.
API though, right?
That's API, but the EIA is usually in and around the same as the expectation, so we'll know that kind of
contentious statement.
Well, we'll find out in the afternoon.
I think like there was a point that like we did a study of like the disparity between API and EIA. Like, are they both showing like draws and both showing builds every week, or like is there a disparity? If there is a disparity, how would the price react? I think Vincent, you've done that, right? What did you find with respect to like the disparity between the API and the EIA release?
Yeah, sure. Usually the API release on the Tuesday, it sets the tone, and on Wednesday people will trade compared. The price reaction is generally seeing if there was a difference between the EIA stats versus the API stats. So if there was a large difference, then perhaps there might be a large price reaction in the first couple of minutes after right after the stats release. So, for example, if API shows a draw, but then EIA stats show a build, then that would be quite bearish naturally.
Yeah.
Do you have how often that happens, that there is a disparity between them, or is it like rare enough that there is such a disparity? Like if there's typically a draw in API, is there typically a draw in EIA?
It depends on ultimately the stocks are not not an exact science. These are all estimates, both the API and the EIA. Generally, the methodology from the EIA is a bit more robust. I can't say for certain how often this happens or how frequent, but it happens.
So you didn't do the study?
There's no discernible pattern, but let's just say.
Did you actually, you got the data though and you looked at it, or?
I had the data, yes.
And it's kind of nothing done. Okay. I think it's worth talking about actually, because I know it is kind of talked to death, right, in the markets, and you do get this releases every week, but it's another indication of how markets work these days, because Genscape, I think owned by WoodMac now, that was huge when I first started trading, 10, 11 years ago. They would come out with an estimate on Monday. So it'd be particularly useful for products, but I think even crude. And so really the market was, or the oil trading market was reacting then. And then we kind of use Wednesday as a liquidity opportunity again. Right. So you kind of buy because you know it's going to be a draw. Then when everyone buys on the reaction on Wednesday, when it's confirmed, you sell. Yeah. Buy the dip, sell the rip type stuff. Now that obviously evolves. And I think everyone's trying to estimate that now. I mean, it's pretty much, I'm not saying EIA is useless, because there are still disparities, and that's probably more to do with a government reporting versus public reporting. You know, what's going to be more accurate at the end of the day. So that's probably the clear difference. But
was that available to like a certain group, or like?
Well, this is the
point.
Was
like
I was
an expensive subscription or
it's
something?
It's an expensive subscription,
right?
So who can afford that? The oil traders. When I say oil traders, I mean the professional, like the trade houses and majors, and some of the tier twos, I guess. So yeah, it's good information to have, but it is publicly available. You just have to pay for it. But you're not going to have a retail trader out there being able to pay 30 grand a year for this. So that's the big thing. But I guess it's kind of playing into how the whole market works right now, right? Like, when is this information priced in? It's whenever the people that can react to news like this do. React, yeah. And I mean, these days we just don't even know kind of when to make those assessments. But we're actually seeing it now with the CFTC report, right? The CFTC report is kind of the new version of EIA stats in a way. Like when that comes out, it confirms what everyone was doing. It changes people's systematic models. I think it's a pretty good stimulus for forward drivers. So guys like ourselves, we're using our data, our proprietary trading data, to predict, using data science and all that, trying to predict the CFTC. So if we come out with data, just like Genscape do a few days before the official release, that's
it's the same idea. Yeah. So, as in, like, especially like over the last 2 years, the data that comes out of CFTC is getting like a really, really good attention from all the market participants, and like it seems like it's really good to explain like what happened in the past, but there is no element of like forward looking how you're going to go about putting a trade on before these data come out. So like that's what we're trying to achieve with the forecast. And like at the moment, I think from the baseline that we have, like 70% accuracy in the model.
For RBOB, right?
For RBOB.
Yeah, and this is kind of seems like this is the way it's going to go. The market accepts it's more financialized, much more financialized, accepts that, therefore, knowledge about position changes is going to move markets. But just like fundamental information, you get that retrospectively. So now it's about the forward looking. So it's we're just on the same journey. So yeah,
this has happened like ages ago in the other markets. Like it's kind of new here in the oil market, but like in equities and
they'd laugh at you if you said this stuff.
Yeah,
you've done it like kindergarten or whatever. Yeah, no, I agree.
Decades ago. Yeah.
Well, it's just the legacy of the oil market and commodity markets. It's a tangible commodity. It's harder to get your head around financial volumes being more important than physical. But we'll keep debating it until the cows come home. That's our speciality. I thought what we do is some of the prep we're doing yesterday. I was saying that the articles aren't very interesting either way, but we did find one from oilprice.com talking about 4 scenarios that could send oil to $200. So we might as well go through that, just provide some context, because, you know, generally speaking, these guys, pretty good at the overall oil news and capturing kind of what people are generally saying. So there should be some resonance. So you got it up there, yeah?
Yeah, I've got it up. This was really interesting because these are kind of 4 points we even discussed on the last podcast.
Do you want to run through them? Just
So I guess the 4 scenarios that could send the oil prices to $200. Number 1, major Ukraine escalation. Number 2, more OPEC plus cuts. Number 3, Russia production cuts. And number 4, underinvestment comes to bite.
So how's more OPEC plus cuts different to Russian cuts? As in OPEC plus
Russian production cuts. Yeah,
well, let's go through it. So major Ukraine escalation.
This was interesting last week because remember you made the point that your old boss used to say that war is bearish unless it's in the Middle East, and I guess this is kind of them saying the opposite to that. So I guess, but this kind of all links to one point. It's not necessarily.
I didn't see this last time. You see, Pierre Onderon went even further, warning that oil could rise to $250 because I think we're losing the Russian supply on the European side.
So it kind of links. It's not necessarily about the Ukraine escalation. It's actually about Russia, which is kind of point 3 as well. So they're kind of all one point.
So doubling down on the supply. But we know already the big shift last year was not so much the lack of supply because, you know, US ramped up, exported a hell of a lot, you know, there was an OPEC cut, but the market seemed to sort itself out. It was the restructuring of oil trading flows and gas flows.
Gas was big.
So this is old news. Russian supply into Europe. I think we were losing the Russian supply on the European side forever. Yeah.
Why does that matter?
It's been shifted to
but it's a big
buy US now.
I think people are over that story.
Europe buy US and they buy just whatever they can that's local, and that's not news, I don't think. So that's, I mean, anyone want to counter that? Devil's advocate, Vincent?
Don't really hit. If I had to give something, it's probably because, you know, Russia is one of the big 3 oil producers. People were thinking, they produce around 10 million barrels per day. What if 4, 5, 6, 7 million barrels were, you know, taken off the market? What if they just stopped exporting? What if they just cut their crude production? What would happen? So there was a lot of uncertainty at the time. Definitely, perhaps 200 may have been a possible would have been plausible, but right now it's just even if there was an escalation, it would not reach 200 because of the way Brent is priced. Because even if Russian oil supply was taking off right now, is that going to reach 200?
I don't. Yeah, I mean, probably would, right? 7 million barrels taken offline. That'd be quite a lot.
Yeah,
I think they're not going to do that. They need the revenue. It's more about the market share stuff, right? So they've sent it east, and I guess the follow-up headline to that is that India imports 22-year low from Russia.
No, from the Middle East.
Was it not Russia cutting to India? That was a headline too.
I think the main thing was.
Sorry, we've got. You haven't got it there. You got it on.
The export out of the Middle East to India has hit the 22-year
OPEC
lows.
Share of India's oil imports fell to those lowest in 22 years.
Yeah.
Okay, so that is interesting because. Yeah, it's all well and good, like restructuring of flows and all that, but Russia go in and take all this market share from OPEC whilst they're in the middle of a cut. They're now fighting over there when the Europe's actually they've got all the oil they need. It seems, particularly it seems from the prices, particularly from all the US exports ramping up. So they're going to start fighting themselves, you would assume, right? They've got the competition to fill India and China, whilst in the meantime. How long can you play this game where you're allowing them to take your market share and not doing anything about it? So what could actually be really interesting, maybe more on gas than oil, but if Russia start flooding the market, because if they start to flood the market with everything they've got, let's say they turn the pipelines back on into Europe for gas, then that would actually decimate the price, particularly where we see the markets kind of as they are right now. They're more likely skewed to the down than up.
Yeah.
Then
in the gas market.
In the gas market, yeah. But even oil is like looking quite balanced, right? If you flood the market with oil, I doubt it would. It's not going to perform on the upside. It probably is skewed to the downside as well, right? So if they did that and they were really aggressive about market share, I mean, you've got to react somehow, right? And I think that, maybe you can get people used to your oil again and all that, and then you turn it back off again, and then it can rally. Do you see what I mean? That's kind of how things tend to work.
Like the March 2020, right? As in like the price war, that kind of situation.
Yeah, that I've not really thought about before. I think it's unlikely because, as I say, they need the revenue. But I think the whole essence of this conversation is these are all old arguments that didn't work last year. Why they're going to work now, type thing, right?
Yeah, I mean, like about India, just like a quick point as well. Like they've got like real stake in a couple of big refiners in India. That's Russians. So like Rosneft owns like 50% of Indian oil, or like they've got a joint venture. And also the Nayara SR Energy.
But if, say, the Saudis or with OPEC allow them to take the market share from them for India, and where do they go? Chinese demand needs to increase that much more.
Yeah.
There's all a lot of hope. I think this comes to boil at some point this year.
But there's this other argument of all the US flows is not going to the east anymore. It's just coming to Europe. So that kind of compensate the flow that was like used to come to Europe from Russia, and Russia is just supplying the east. All these WAF interest or like US interest that would go to the east. Now they're just like ending up in Europe, and all the Russian flows are just like in China, and it's kind of just like replacing it. It seems like it is more optimized in a way. Like looking at it like geographically, maybe Vincent can like have a way in here coming from geography. No, his background is in geography.
I have a geography background. But let's just say, at the start, I guess when oil prices were shooting up, there was a sentiment maybe Russian oil was going to be cut off, and also perhaps that sanctions was going to really affect the oil industry, and yes, it did. But I suppose the purpose wasn't to of the price caps wasn't to cut off Russian oil, but it was to ensure that Russian oil would continue to flow, providing that the oil was sold below the price cap. So essentially, it doesn't severe any flows, but then it just redirects flows to different places. So how would that materialize? Perhaps that would change how freight routes are priced.
This redirection is like optimized, no? As in, it's much easier to.
Sorry, just to quickly say, this last week when we were talking about renewables and how the infrastructure needs to improve to compete with the oil markets, or at least learn from the oil markets, looking at it through that lens. That's another kind of bit of evidence. So we had this unbelievable disruptive event to oil and gas, and within 6 months, it's all realigned and it's all sorted itself out. The big move is all the oil traders are going to Dubai. There's a big shift to like staff going there. That was like almost instantaneous. There's a lot of activity going on. Barrels are moving. Nothing's changed. What's changed is the redistribution of and how trade flows work. But I mean, not even freight prices have really benefited from that. So I mean, there's just kind of nothing to be said. And I think articles like the one we're going through just is hanging on to old narratives. If anything, I'm almost reluctant to talk about it too much because it's kind of boring, right? Anyone who follows oil has been hearing this for so long. And on that point, we've got the last point. So third point, Russian production cuts, like you said. The fourth point, underinvestment comes to bite.
That one's interesting.
Is it? I mean, that's been said for years.
I don't hear it too much, but I just think it's a narrative I don't hear it talked about that much. But
that was the leading narrative since 2020, right?
Really?
So 2020, Saudis flood the market with 12 million barrels from 10. And OPEC in general were happy to kind of flood the market. They then cut, and then we had the COVID kind of rebound, and flat price went on a non-stop rally. a year later, Biden, Macron, Johnson, all trying to speak to the Saudis to try and get their production up again. And not just them, the whole of OPEC, Qatar especially. And they said, no, sorry, you guys haven't invested enough in oil. So we don't have any spare capacity. So how do you go from 10 to 12 overnight, back down to 10? You do a big OPEC cut, and then suddenly there's not enough investment. It just doesn't hold up. And by the way, exports from the US have gone up to, what did we say, 5 million barrels a day from about 2 around about that time. Oh no, sorry, pre-COVID they were around about 4, went back down to around 2, and then kind of back up to +5 now. So there's plenty of oil in the export pool. It's just not true. The underinvestment is just, someone needs to give me, I mean, hopefully you can be devil's advocate here. Like, how can there be underinvestment? We're producing more oil than ever, and we're in the middle of an OPEC cut, and there's wars, and there's plenty of oil. So, I mean, that's just my view. But I thought this was just, I mean, it was definitely the research houses. This was their leading argument. We didn't invest enough. The capex kind of, bottleneck. And so, look, there's going to be a supply crunch, but that's not true.
We see it come up every now and again in articles, but I don't think this demand or this narrative is driven too much.
And the oil market's not stupid, right? We've got some of the smartest people like in this industry. I think it's more people want to believe, or at least want to go along with these narratives, because
it is very herdy though. Like even if it's like very many smart people around, is like
people are people at the end of the day.
Yeah,
no, agreed. Okay, so I guess moving on from that article, that kind of a discussion that we were just having, let's give our case in terms of what we think like the state of the market is right now, right, where it's going. Ehsan, what do you think generally is the key driver at the moment, let's say?
Yeah, I mean, it is quite a unclear market, because the financial flows are quite balanced, and we've got to wait and see evidence of new flow coming into the market, and this hasn't really happened. But in the back end of the curve, there is some interesting stuff happening in Q3 and Q4, and especially in the Asian jet market. We talked about it like 2 weeks ago. There is definitely like some real buying interest coming in, and even Brent Dubai, which is quite an interesting case. In the back, there's been a little bit of buying. People are buying, and it seems like the Dubai strength has been like kind of overdone now, and we've got to see like how that's going to affect the refinery margins, especially in the back. So at the moment, it doesn't seem like refinery margins are healthy, especially given like the physical premiums are quite high, and like margins, prompt, margins in the paper is not very good either. So it's just gonna probably like we're gonna see a reversal in the jewels of the refinery margins, like EBOB crack and gas oil. It just makes sense. It needs to be economical for the refiners to run. So something's got to give, right? It's either like a pressure in crude, or you've got to see like some sort of like reversal in the valuable part of the barrel.
It is said that, of course, distillates have came off by quite a lot since January, February. I've seen it's been said that Asian refiners is actually switching to gasoline production over gas oil, purely because ahead of they want to be ramping up the slightly more favorable margins in gasoline ahead of the summer driving season as well. That's interesting. And also it is on the physical side, I hear that of course the OSPs, the Saudi Aramco's OSPs for light grades might be getting cut for the month ahead for June, owing to of course lesser demand and weaker refinery margins as well. So there's less demand for crude from refiners. But on the other hand, what's interesting is that perhaps there's an expectation that the differentials for medium and heavy sour grades might be increasing by a teeny bit, just because the fuel oil cracks have been performing quite well recently, especially the high sulfur fuel oil 380 market has been trending quite well, and from Onyx data shows that there has been a lot of buy-side interest, especially in the Q3 barge cracks.
Yeah. One thing though, like about the OSPs, that's quite interesting because so OPEC cuts production to basically like drive the benchmark higher, so they don't have to like charge so much on the physical premiums. But the price moves, it hasn't been substantial. It is like we are where we were kind of before the cuts, and now they are slashing their OSPs. It's kind of like it seems like a clear admission to failure of reading the market, and now they've got to like charge even less for physical crude. It seems like within a month after cutting production, you expect to generate more revenue because the price of the benchmark is going to go up, but now you've got to slash your OSPs as well.
Yeah. No, actually, do you know what you say about the Singapore refineries or Asian refineries gearing up for gasoline for summer driving season? I just looked at the flux data, our fair value stuff for Onyx. The East-West, like the gasoline East-West difference in price between East and West, have been on a downward trajectory all year. Minus $5 per barrel in Q3. And if you look at the RBOB versus EBOB, so US versus Europe, that's pretty high as well. It's like $24.
24 cents a gallon.
24 cents a gallon, sorry.
Yeah.
So that is pretty strong, right? If you combine those two, which you have to, because you have to take Sing prices minus US to get that full arbitrage. Yep. And they are very, very good levels, economic levels to move barrels
from East to US.
Yeah. So the bullish hope this year, as you say, on the back of refinery margins not looking very strong, is probably the US driving season. It was at the end of COVID, 2021. It's all kind of repeated itself every year, that Q3 people are hoping. But this year, you've got this wide open arbitrage, or at least economically favorable conditions to move as much as you can to US. They're already struggling with stocks as we get towards driving season, which is not a good sign. So if they're ramping up and all the crude that they can buy, they're converting as much as they can into gasoline and then sending it to US, and then the Europe also sending to US, and then the US producing it themselves with a lot of light sweet available, right? All the increased US production is all light sweet. So that doesn't bode very well for a fundamentally tight market. If the refiners come in and hedge these oil traders come in and hedge these arbitrage routes effectively, which they always do, then the market should be in theory flooded, or at least a cap on that kind of production. And so anyone hoping for a supply deficit in Q3, I know the classic thing is to look at supply and demand models, and you say, where are we now? Where are the stocks? What do we expect the demand to be? What do we therefore expect in Q3 for the supply and demand balance to be? But that doesn't really work when you factor in the oil traders can buy Singapore derivatives and sell US gasoline. They can do it in as much volume as they can, as long as it equates to physical movement of barrels. Yeah. And no matter what the supply and demand balances are saying, they will move those barrels over. You have to factor that in. You can't just say it's going to be tight when it's...
No, that's definitely interesting what you said, because when you started talking about East-West gasoline, I just like went on to our dashboard to just have a look at like how the positioning has changed over the last month.
Show that right on this.
Yeah, I mean, like the context. I think my screen is like
okay, good.
Like people can see it. So like in the Q3 tenors, what we are seeing is that in July, August, and September, we were like market overall position was like a lot more skewed towards the short side. But what I was comparing here was, a month ago, what we were in terms of like overall positioning. We were a lot more closer to minus like 75 to 25 on a short to long basis. But now,
big switch, right?
Yeah, there's definitely like some evidence of like there is length coming in the Q3 East-West, and like market is getting less short. So
clear evidence of hedging that movement of barrels over. Okay, so refinery margin is terrible. Where are you going to get your increased margin from? Sending it. So that's That's pretty key, isn't it? If that's what everyone's hoping for, we don't think that. I guess what we're saying is we don't think that's likely.
Yeah, I mean, like I think the importance of this is like we can really see where people are betting.
It could be hedging or speculating, right, or both, right? But
yeah,
I think at the moment it's probably more likely hedging,
as in like buy side hedging from
getting prepared for this. But it's rare to see it so discounted, right? I mean, the Singapore versus US, so I mean it makes complete sense. So just getting that overall picture, what was meant to happen was tight market. What have we actually got? Well, our indicators for what is a tight market in the spot market genuinely, or not even spot plus, kind of 3 to 4 weeks out, because that's what the derivative markets are priced to. They are indicating a very strong market in May, dated Brent. But if you understand the nuance of dated Brent, that was kind of well understood and well priced in probably about 3 weeks ago. And so that's kind of pricing out as expected. If you look at the June barrels, the June loading differentials, they're all a hell of a lot weaker. There's a hell of a lot of selling in dated Brent in these weeks because a lot of traders they need to kind of hedge barrels loading in from the US now with the WTI Midland being as part of the dated Brent and Brent crude assessment. But also in general, just the flows coming in, the physical flows coming in, they need to hedge. And there's been a lot of selling in dated Brent in the June dates. So there's a huge difference between May loading and June loading, right? Just because May's strong, that doesn't actually indicate forward demand is hugely strong. It indicates for May it is. In June is the physical that's setting Brent crude futures. So you've got to look at June-July Brent spread. June-July Brent spread was 4 cents this morning. By the time we finish talking about this, it could be in contango. Says something very real. That says what the physical differential is, right? So if the physical differential is plus 160 in May, which it is, the forward physical differential for June is like negative. So that's a huge distortion, but it's the reality. So actually what we're saying is the sense of health in the market isn't there, at least from the European crude side. Then if we look at Dubai, Brent Dubai should actually be selling off because Dubai is the Middle East and that's what's getting the cut to production. And obviously Brent is West, but actually it's the opposite. Brent Dubai is going up. And we know from our analysis, that's from market effectively being too overextended short and they're kind of covering, buying back, trying to take profit because they probably likely are in the money and they don't want to lose it. They don't want to lose those profits. So it looks like there's being a bit of a rush to buy those back. But even more poignantly, the Dubai pricing is not that strong. So all this hope of like physical differentials being really high, it's been and gone. It's actually the forward differentials look really weak and the market's in trouble, at least that's what the indications are. Then you add the refinery margins. The refineries aren't going to come and save the day from the oil traders who've been picking up the barrels because they're not making any money at these levels. And it only looks to be getting worse. So maybe the Asian refiners, or the Eastern refiners can get some relief from this gasoline switch, like you say, Vincent. But this all spells a market physically oversupplied and physically under pressure, despite the cut. So then we need to look at the derivatives. How are people going to position off the back of this? Well, like you guys just mentioned briefly, it's the gas oil that everyone had a lot of hope on this year. There's been endless stop outs of that, and there's been shorts generating a lot of revenue being short gas oil. So I think the markets, well, personally, I think what this all leads up to is a risk reward skew being to the downside. All the events in the world couldn't bring oil up sustainably above 100, Brent crude futures that is. With everything indicating in the forward markets that it's weak, I think we go a hell of a lot lower. But please, if you disagree, obviously say. I mean, we did have this debate at the beginning of the year. I didn't think OPEC would cut, and they did. Yeah. And that kind of did have a temporary kind of bullish impact. But I mean, now it feels like everything's pointing that way. Is that fair?
Yeah, I mean, like it's quite difficult to find narratives for Brent crude like exceeding 120 or even 100. But again, like the risk to the downside or like the move to the downside again is quite unlikely as well, because there's clear, to me, there is clear indication of there are market participants, there are bodies in the market who would protect the price if it goes down. There's the SPR buybacks, like there's always going to be there. I don't know, 60, 65. And there is going to be something that is going to hold the market. And obviously, like there's the will from OPEC to really control the prices, even though they've tried it many times. if the prices come under pressure, again, things might get really, really ugly, and there might be like a proper price war to just like knock out a couple of producers, and then after a really big pressure, we're just going to see a big reversal. You think in the
long run it can't sustain itself too low, but in the short term we could get a shock downwards, right?
Yeah.
I would agree with that. I mean, if you're playing like on the chessboard, what cards you have, or the pieces you have, the only move you got left is a price war, is a flooding the market, gaining market share from a producer perspective. US are already doing that, right, by ramping up exports. So they're just very happy with the market share, I would argue. The Eastern guys, they need to kind of get a plan together, and it could be that they start fighting with each other. And if that happens, that's the price war, and that's a huge correction in the market. I'm not sure we go back to negative oil or anything like that, but I certainly feel what does happen with a correction is, let's say we get a $20 move down to 60. The markets can reset, right? It's a very different market, 80 to 60. You expect some end user demand to come in with a lot, inflation being
structure
eased.
Of the curve would change.
Yeah, it's you get a kind of great like almost tax relief to the end user. That's how Trump used to put it. Actually, he said it's like a tax cut. So if that happens, maybe summer driving season just goes through the roof in terms of demand. People are like, great, prices are so much cheaper. Let's all go on holiday, and you can start draining stocks, and we get back. But the other thing is a reset allows kind of the market positioning to kind of even out and all that. But we have already said it's kind of balanced. Yeah. So it's all, I kind of see your point, as in like if a market is balanced and there are kind of genuine like things lower down like the SPR buybacks and things like that in play, then long term, we're not necessarily out the woods yet with the gas prices, things like that. There's at least new buying that can come in that isn't there right now, given the open interest is so low, given everyone's staying out of it for the moment. That could easily drive prices higher on a position basis. But they just need a strong narrative, and maybe they get it once the market resets, is what I'm saying, but they definitely don't have it now.
Yeah.
So on that note, I mean, gas is just the crazy one, because it was so unbelievably volatile last year, and it was such a driver for everything, which rarely for oil. And now it's the complete opposite, and all the hopes that oil traders had by getting long gas oil because of gas prices, things like that, that's all dissipated. And the market is, from what we understand, is pretty crap. So we were going to give our LNG trader / nat gas trader Benny a call on the trading floor and get him to weigh in. But before we do, any more context to that? I mean, it's just low vol, like kind of seems fundamentally oversupplied. There is the worry that things could happen later on, but I guess we're as uncertain as anyone else, right, at the moment. Yeah,
I mean, Audrey, maybe a place for you to have to weigh in.
I guess what everyone was kind of banking on was that kind of like weather-driven demand coming in there for summer, all the cooling demand picking up in Asia. That hasn't happened yet because temperatures are actually seasonally low compared to what we saw last year. Like temperatures this time last year had already kind of picked up. But it's a hard one to call.
Well, let's get Benny's opinion. Yeah, he's on standby. So this is the first time we're doing this. It's gonna be quite fun. Hey, there he is. So Benny's been on the podcast before. Anyone listening out there, he has been on before. Got some great views, great opinions on the market. But Benny, we're just saying that completely polar opposite to last year. Uncertain markets, low volatility. Like anything to add, or generally just is that what's going on, or how do you feel?
Yeah, I guess we're asking kind of why is gas so low. Actually, today we hit 38 handles, which is
on TTF.
Kind of a recent low for TTF. Probably the low since, August 21, which is actually quite frightening. I mean, the main thing is high storage, and it was kind of touched upon, like the spot market in Europe and kind of the storage market just becoming really disconnected from like the long-term contract supplying Asia, seeing like reversals of cargoes, to be honest. Like Chinese are selling back to Europe because LNG is still more expensive in Europe, and you've just got these kind of Brent index cargoes going to Asia constantly. Like governments lifted gas in the summer, lifted cargoes, basically PA or kind of really like OA, like on our accounts, because it's at the cost of taxpayer. Actually, Bloomberg is suggesting, I think, that like a continuation of the demand destruction we're seeing, because I know we've seen TTF at 350, but we have to remember that kind of before August 21, the all-time high like of TTF was about 40. So TTF is expensive in kind of the grand historical scheme. of prices. It's just cheap for the last 2 years. But Bloomberg is saying kind of with gas up here, with industry not really functioning at these gas prices, like the Europe perimeters are like Northwest Europe, Italy, Austria will completely fill their tanks by Sep for the winter.
Okay. So not even the threat that people are expecting come the end of the year is likely now, you think?
Well, what is the real next step for Putin? What can cause another crisis? Yeah. Like, the taps are already off. They're not really sending anything. Like, unless.
But do you remember we were having that debate yesterday that actually the reverse could be flood the market, right? We were just talking about that earlier.
Yeah. So, but then, that would only push gas lower, obviously. The economic weapon that Putin has is switching it on and flooding the market. I don't see that happening because, like, in the political sense, that's perfect for Europe. That's what Europe wants.
To gain reliance again, only to switch it off again, just cause volatility, I guess.
But that has to be a 4 or 5 year play.
Yeah.
I think if Putin said, I'm going to send gas again, people aren't going to believe him unless it's got a 1 year track record of actually flowing it. So maybe like winter 24, you could look at him messing around, turning it off again.
Yeah. All right, cool. And in terms of trading conditions, Benny, like just very different from last year, right?
Yeah, I mean, I'd say it's boring. Boring is a matter of opinion. It's very range bound. And kind of as we were discussing yesterday, there are like two types of gas trader. Those who have really only known volatility, which is me, and those who have known kind of two regimes where TTF barely moved all day and where TTF was moving 30, 40 euros some days. I think firstly it's kind of boring just because, as we said, like there's nothing to move the market. Audrey touched upon weather. It's been standard, if not warm. No outages on LNG trains or regas like in Europe. And no surprise supply changes. We know it's all LNG. We know that it's coming across the Atlantic and really getting it from North Africa or Middle East. Secondly, a lot of players just don't really care. They've reduced their risk and they're not adding it on. Like, I hear in the market the spec guys picking up the phone to brokers or banks and saying, don't call me till it's moved. Like around between 40 and 50, I'm just not interested.
Yeah.
And the guys that do have risk seems downside directional risk from what I can tell. Short spreads, short bit flat price with some long gamma as in long optionality or long vol. I can't speak too much as to options vol if it's overpriced or not, but I think we're not going to move that much until injection season. Like in the end, the markets are moved, as we always say at Onyx, by players anticipating moves and putting on positions, or players reacting to fundamental shifts and changing their position. So in this case, nothing's changing fundamentally, and no one really believes that in the near term anything's going to happen that's too crazy either.
Great. Benny, thanks a lot for taking some time out of the trading. I think Harry Styles in the background wants to speak to you, but cheers. I'll see you in a bit. I meant Jasper, by the way. All right, cheers, man. Speak to you in a bit then.
Thanks, man. Cheers.
That was the first time we've spoken to someone on the trading floor via this system, so I hope that worked. People viewing it on YouTube, do more of that. But no, that was interesting, right? I mean, boring is the word, and that's kind of boring translates to low trading activity, low open interest, which is what we're seeing on Brent as well. So that is the conclusion of this in the current state. So we can all go to sleep and hibernate until things are ready to kick off again.
That is true in the front for JKM and TTF, like in terms of open interest, like it's lagging behind the previous years. But the activity in the back, it's not too bad. As in, like, obviously, like those markets are growing, and like if you were trading these benchmarks 5 years ago, you would probably get like a tenth of this open interest than it is now. So there is a bit of a skew, similar to the the VLSFO market, that like it started off, people started trading it, and then now it's just like gained a lot of like market share in terms of as a benchmark for trading. So it's a similar case there, but like for example in Q3 TTF, current open interest is actually above the 5-year average. Again, like the 5-year average, maybe it's not significant as the other stuff that we look at. Like it's not comparable to like 5-year average of Brent, obviously. But these markets are growing, and there's like a sign of that. But it seems like it's positioning for the injection season.
Yeah. But it was quite compelling, right? Like that we're fine ultimately in terms of injection, needing it for storage for winter, at least from the Europe perspective, and actually selling back out cargoes in Asia is pretty big sign that.
Yeah, is that like at these levels, I think one of the articles mentioned that like we are like close to cancellation territory from all the LNGs that are booked out of US to Europe.
Cancelling cargoes.
Cancelling cargoes coming to Europe. Yeah. Okay. So like the levels are just like so low.
Yeah.
It's not that economical to move stuff over to Europe, and Europe is doing pretty well.
Yeah. So again,
sorry, I was going to say just Benny touching on like the storage in like Italy at the moment is like 62.85% full. Like that's massive. Cumulative storage is like 58% full. That was Monday. So it's probably like, it's trending towards 60%, and it's not even May yet. And they're aiming for, I think, like 80, 90 kind of by end of summer. So yeah, it's really, really high. Some countries are like Austria, 67%.
Well, hopefully good news for the end user.
Again, you have this people saying high storage right now, things are looking good for Europe. But then at the same time, there's people saying, yes, you have that, but don't get complacent. There'll be competition with China. Of course, Europe got very, very lucky in the winter last year. Very, very mild. We had a title in one of our reports, I think it was, or in our videos, it was called Global Warming versus Putin. But it might not be the same for the upcoming winter.
Yeah, I think weather is going to have a massive part to play. And like Benny said, and I mentioned, it's like it's just really kind of tepid at the moment in all regions. It's chillier than people were expecting. People expected kind of last year's like soaring temperatures. It's not that, but it's not particularly cold either. So we're not in like heating season. We're not also in cooling season yet. We're kind of in no man's land in terms of like weather at the moment. But yeah, this winter will be really interesting to see, what the temperature.
As in, you can go out with like a just light jacket or something.
Yeah.
You don't worry about things too much.
Cool. So I think in general, it's both markets, oil and gas, and probably collective commodities, could do with a reset. Essentially, could do with a shake up for next. Otherwise, we kind of look destined to be in a little bit no man's land. But I think we'll leave it there. That's all we've got time for today. We'll let you guys all get back to work. That was a very enjoyable podcast, and glad to see we could get Benny up in there from the trading floor. So hopefully we got more of that for you, and hopefully more visuals in general, the articles we're looking at, just try and kind of get that immersive experience a bit better. Please tune in next week for more. Thanks, guys.
Thank you.
Thank you.
Thank you.